Hi, I'm James Nelson, partner at Mascanackle Realty Services, and I'm here to bring you the Nelson Reports December 2012 podcast. I'm back in the office, as you can see, but at least I'm standing up, trying to keep you all on your toes. In my last month's blog posting, I talked about what the effects of the election means for New York City real estate. Well, I can't say it was that much of a surprise or it didn't have that much of an immediate impact on the market here, because a lot of owners had already elected to put their properties on the market in hopes of closing this year to avoid a potential capital gains increase next year. As a result, we saw the third quarter of Manhattan record the most sales since 2007, and we're expecting that the fourth quarter will even be busier. We're still getting calls from a lot of buyers asking, is it still possible to bring their property to market and close this year? The answer for them is fortunately yes. We're seeing a lot of buyers out there who've been waiting for this moment. They stand ready to close all equity for the right opportunity. As far as other short-term impacts of this election, I was at a revenue lunch yesterday, and SL Green's CEO Mark Holliday made an interesting point that New York City could be a great beneficiary of the U.S. government after all these years of sending many more times tax dollars to D.C. than what we get back. You know, unfortunately, with the recent events of Sandy, we might actually see a benefit here as the U.S. government will really help get behind us to help rebuild the infrastructure here, which is very much needed. So this could be a benefit for our market here. You know, again, when we look at the New York City market, I know many of us think that we're a world unto our own. We certainly did survive this last downturn because we weren't overbuilt. There wasn't speculative building. Vacancy is now approaching all-time lows again. In Midtown South, for example, vacancy is down to 8% for office. Rents are once again achieving all-time highs. And supply and demand has been working in the seller's favor. For example, in 2007, our company had 750 exclusive listings. Today, we only have about 500. We just can't keep up with the demand. So, although the fundamentals are great here in New York City, we can't ignore the world stage, and we have to talk about what is going on behind the scenes. This fiscal cliff that we're approaching, you know, we're looking still at $1.27 trillion in federal deficit this year. And when you take into account the fact that we're now racked up about $16 trillion in debt, if you look at the unfunded Medicare and Social Security payments, we're now up at about $88 trillion. So at this point, that figure is staggering. It's about 550% of GDP. So, you know, what is the solution to this at this point? How do we avoid this downward spiral? Well, it seems pretty clear that Bernanke's going to stay in his position. He's going to try to keep interest rates as low as possible, but the market might not allow him to. You know, so in the short term, the stock market may have a surge. And as Gary Barnett put it in yesterday's revenue luncheon, you know, if the stock market's doing well, people are happy, they're buying apartments, they're hopefully taking out more office space. So in the short term, again, I think yields are going to stay low. They're going to hopefully outpace inflation, which unfortunately I think is really inevitable. The Congress really has to get aggressive, and they have to finally make some tough cuts they've been talking about for a long time. I don't see how it's going to happen, but if not, we're certainly headed the way of Japan, where their deficit runs at over 200% of the GDP, which has led to really their lost decade in stagnant growth. I don't think the U.S. can tolerate this. We just can't accept these low returns where we can bail out our economy. So the only solution is going to be to continue printing money, which could lead to hyperinflation. So I really hope we don't go the way of the Weimar Republic and we get things back on track. But for the short term, expect for sales to remain at peak levels, although next year with the anticipated capital gains increase, I think it could be a bucket of cold water, and I don't think we're going to see the volume that we saw this year. So that's it for this month. Enjoy the holidays, and I look forward to being in touch. Thank you.